Welcome back. We are going to go over Chapter 2 this week. Before I go over that, I want to just remind you that we did introduce in Chapter 1 what managerial accounting is and what it isn't, the type of differences that are noted very specifically between managerial and financial accounting, how our emphasis will be internal users, how we are going to be concerned about how to improve operations, how to determine costs, and how to evaluate costs, not only in terms of products but also services and also the flow of goods in that respect. So let's dig a little deeper into some more fundamental concepts that are specific to managerial accounting. In the chapter, once you've completed the reading, watched the videos, and also participated in homework and discussion, you should be able to distinguish among service, merchandising, and manufacturing companies, understand and describe their value chain and their elements, make a distinction between indirect and direct costs, and also determine what are product costs and period costs. These are terms we talked about in Chapter 1, but we're going to really dig into them a little bit deeper because these terms are going to be following us all the way through this course. Also, we're going to prepare financial statements for service, merchandising, and manufacturing companies. And we're going to also talk about what costs are relevant and what are not in terms of decision making. And we're going to be classifying costs in terms of fixed, variable, and also mixed. So what makes them different? Service companies, obviously, we have a service company that provides some kind of service and that you can't touch it, you can't feel it, but you do benefit. Merchandising firms are like a Walmart or a Target, which buys products that are already manufactured and they resell them. Manufacturing firms are like cars, dealerships, and also for clothing, manufacturing computer parts, etc. So we have an intangible service. Insurance and banking is one of them. Many more service companies. Obviously, they have no inventory because they are selling something that you can't touch. Merchandising are going to be a reseller, and they obviously buy from manufacturers and other suppliers, and they resell it to you and me. Sometimes they sell it to other firms as well. So, you are very much aware of Walmart and Best Buy, but Target's also a merchandising company. Retailers usually are going to be the Walmart. Wholesalers are going to be ones who sell to retailers. Every once in a while you can purchase, you and I can purchase from a wholesaler, but for the most part we're going to be working with, in terms of buying and selling, with retailers. But it's important to note that these organizations have very unique cost systems, but the principles that we talk about in this course are going to be very general and very universal in application, but how they're carried out with a Walmart of the world may very well be a little different depending on their particular need, and also depending on their accounting systems that they use. Manufacturing companies, obviously we're talking about companies that take raw materials and create something that you can touch. That could be a car, it could be a computer, it could be a phone, those types of things. And it just gives you the types of inventory that's particularly relevant to a manufacturing. Let's go back to the merchandising firm. They carry inventory, but their inventory is going to be finished goods. Like in a Walmart, it would be household goods, or guns, or I would say probably food, and they could subcategorize the food in terms of, cereals and that products, or vegetables and so forth. But in the end, they have inventory of goods that they're going to sell, and those goods are already manufactured and created just for resale. So now, if you look at these organizations, you lay them side by side, you can see some subtle differences among them, none of which I think you would be surprised because you are very much aware of these types of differences. But it's important to know when we're in this class, when we're talking about manufacturing and merchandising, there are differences in terms of how we present the information and what information that they need. Noted here are the types of items and activities that add value to an organization. Obviously, research and development, where they go out and they see really what's going on in the marketplace, and to see what kinds of holes that are missing, things that consumers may want or need that's not being provided for. Research and development really is about finding an idea and creating an idea and determining if that idea can be marketed, in which case they would create a design That design would be something what it looks like if we could give our consumers what they wanted and how they would want it. The design or a prototype would be something that they would have to create, something that they would put together to see what we would add value, how would we add value to the world, how could we provide some type of service or product that someone would need and how it would look. Then the process, based on the design, they go through a process of how can we put this particular product in action, how can we create it, what type of things and activities that we would need to do and services that we would need to purchase in order to create this design. And based on the information that we provided in the previous steps, we know kind of in a way what market we're going to be going after, what individuals or organizations would want our service or our product, marketing that. If it's a vehicle, obviously, depending on the type, if it's a midsize or an SUV, how would we market that particular product to a very specific audience? So marketing becomes a very important part of that strategy. And once we market the product, we know who wants it, we know how much they're willing to pay for it. How do we get it to them? That's the distribution process. And again, how do we locate our offices and our warehouses or where customers can get to us? And distribution could be online. It could be a particular site or location. But in the end, all of the strategies that they put in place to distribute that product is considered what would be the best for the organization and how we most efficiently get that product to our customers. And then once we have that determination made and we're in the process of distributing, we have to again work with our customers, give them what they need, answer their questions, provide them with education about what we offer, and just really service our product to our customer chain. So in doing all of that, we want to make certain we support people after the sale, but really even before. If we know who our potential customers are, we want to make certain that we understand what they're saying, what they're asking for, what they need, and how can we meet that need in the most efficient way, obviously. So indirect costs and direct costs. We talked about this a little bit, but I want to go into some a little more information. What are costs? And depending on the organization, if it's a manufacturer or a retailer, we're going to talk about our costs, the type of marketing strategies, the type of segments and departments that we need in order to classify and to track costs, the different units that we'll need to create. Again, if you were talking about a manufacturing entity, we want to talk about the assembly department, or we want to talk about the fulfillment department, those types of costs and those types of areas that we will be tracking those costs as they move down the process of being sold. Costs that are associated directly with an object is going to be a direct cost, and then indirect costs are going to be costs that can't be specifically attributable to a product. A direct cost, again, it has to be a direct association with that particular product that we're actually manufacturing or reselling. And then indirect costs are generally going to be costs that are associated with the process but not to a specific product. So we're going to allocate those costs. Product costs and period costs. Product costs and period costs. Now remember, period costs is going to be different from product costs, and we talked about that a little bit. We are going to be very much concerned about internal decision making. So we are concerned about overall all costs associated with producing a product to ensure that we have a reasonable amount of profitability. But our product costs are going to be costs that are incurred to produce or to create or to manufacture a product. It relates specifically to inventory. Period costs are not treated as inventory, and they are really operating expenses, and SG&A are typical examples of that. And take a look at this spreadsheet here. It really does give you an idea of how product costs and period costs are differentiated and how they are reported on specific financial statements. Again, from a merchandising perspective, you would see product cost versus period cost. Freight in, obviously customs would be really those type of costs that we would incur to deliver a product to our customer, and then the cost of the product itself. So there's some distinctions between those two, but again, we're talking about what we need to do to manufacture a product and what we need to do to resell a product. Two different perspectives, very similar, however. So from a manufacturer perspective, our product cost is going to have everything to do with our direct materials and our direct labor, people who are actually working to assemble this product, and then the overhead costs associated with that, which would give us in total our product cost. Now remember, in your textbook, they're going to give you many examples of indirect costs, or in this case, overhead. And for the most part, you can rely on indirect materials, indirect labor, and indirect manufacturing costs. But there are no games here. You're going to be told exactly what costs are going to be directly attributable to a product and what costs are not, so that you will be easily able to make that distinction when you're actually asked to allocate a specific overhead cost to products. And here again is another visual of how a manufacturer's perspective of how costs are split out and how they look. Prime and conversion costs. Prime costs are going to be indirect costs plus direct labor. Conversion costs are going to be manufacturing overhead and direct labor. And again, the most important thing with this slide is to know what are the components of prime costs and what are the components of conversion costs. Additional labor compensation costs, salaries and wages paid, also fringe benefits, including health and retirement, etc. So now, before we go any further, the most important, I think, of this learning objective, number 4, would just be understanding what the differences between period costs and product costs, understanding the differences between manufacturers and retailers or merchandisers in terms of their costs, their product costs, or their overhead costs. And also another thing to learn about objective number 4 would be to understand the differences between indirect costs and overhead costs, and what types of items that are included in overhead costs and how they are allocated in general terms. Next, we're going to talk about how financial statements are prepared for these different types of organizations. This one here is basically a service organization, their income statement, which is going to be the profit and loss statement. And you can see very straightforward. Here are our revenues. We're subtracting our expenses. We're going to come to a total number of expenses, and we subtract that from our income to come up with our operating income. But a merchandising firm does have another layer, and we want to go over that. And if you look at the sales revenues, we want to have gross sales, but we want to be able to determine what our gross profit is. And to do that, we need to find out how much did the goods that we purchased cost us, our cost of goods sold. So we are now seeing a layer of gross sales, then our gross profit, less our operating expenses to come to our operating income. Now, for a merchandising firm, cost of goods sold is going to be calculated by taking the beginning inventory, adding our purchases, and subtracting any returns, getting our cost of goods our cost of goods available for sale, and we subtract our ending inventory. Very important calculation. Beginning inventory plus our purchases minus our ending inventory gives us our cost of goods sold. And this is going to be important because you're going to see different types of questions asking you, well, if you have your cost of goods sold and you know what your beginning inventory is, can you determine what your cost of goods available for sale is? So knowing the relationship among these variables is going to be important. So perpetual inventory system, again, perpetual system we talked about in Principles 1, and what that tells you is the flow of goods, how the goods flow. The perpetual system assumes that you're going to always be recalculating your ending inventory at every time you purchase and every time you make a sale. So ending inventory is going to be constantly updated perpetually. And organizations like a Walmart, for example, or Target, they use a barcode system because it allows them to track a particular inventory item from the time they purchase it from a wholesaler to the time it's sold to you and me. So a perpetual system, again, is going to always be tracking ending inventory as it is adjusted for sales and purchases of inventory. Periodic basically is going to be at the end of a period, and generally you're going to use an inventory count in order to determine what your ending inventory will be. So periodically you'll know what your ending inventory is, but not every time a sale or every time a purchase is made. And it does have importance because you can also, using your actual physical count. You can determine, theft, errors, obsolescence, that sort of thing. But perpetual system does give you immediately what you're in an inventory, versus a periodic you'll have to calculate it based on an inventory count. Now, it's important to note that perpetual system, you will be doing an inventory count, but because of the accuracy of the barcode system and an accuracy of tracking your inventory as they are purchased and sales, once a year should be sufficient to compare your perpetual to your actual inventory count to ensure that there's no theft and other items like if you have your inventory is something that will die over time, meaning goods and services, goods that you are selling in terms of products like foods and grocery items. Those items have a very short life, and sometimes you might not sell your tomatoes in sufficient time, and you may have to write them off because of spoilage, for example. But those types of adjustments will occur when you do periodic inventory counts, that sort of thing. But in the end, periodic and perpetual really depend on the organization, and most organizations will use perpetual because of the volume of their inventory. So cost of goods sold in the manufacturer. So again, manufacturing, here's their income statement. Again, we talk about cost of goods sold and gross profit, etc. But let's look at how cost of goods sold is calculated using the manufacturer's perspective. Again, we're going to start with our beginning raw materials, because we're talking about raw materials here. A manufacturer is going to have to start with raw materials. They add their materials, purchase of direct materials. They have their materials available for use. They subtract their raw materials ending inventory, and they will come up with their direct materials used. A little difference of terminology, but in the end, we want to make certain that the manufacturer starts with raw materials. They add more materials to that. That's the materials that they're going to use to manufacture whatever product that you're trying to build. And then from that, you're going to subtract your raw materials ending inventory. And that number gives you the direct materials used. And that's pretty much the equivalent of your cost of goods sold, or your cost of goods manufactured in this case. So let's take about cost of goods manufactured. Now, I'm going to go back real quick to look at step one. Now remember, we're talking raw materials beginning, purchases, ending raw materials, and our calculation of direct materials used. Now let's take a look at how we process our cost of goods manufactured. Again, we start with our work in process beginning. Then we're going to add costs. Our direct materials that we use, which we calculated in the previous screen, our direct labor, and our manufacturing overhead. Now, this number here, 47,000, is going to be the combination of all of our costs incurred during the period, which is the 14,000, the 19,000, as well as the 12. Then we subtract our work in process ending inventory to come up with our cost of goods manufactured. Remember, cost of goods sold for a merchandising firm and cost of goods manufactured for a merchandising firm. Difference in terminology, but the concepts are very, very similar, and you can actually see that although we're using a different terms, they are pretty much the same in terms of what we're trying to achieve, what is going to be shown on our balance sheet, and what's going to be shown correspondingly on our income statement in terms of our asset of inventory, in terms of our costs and our expense, which would be on our income statement. So again, cost of goods sold then becomes our finished goods inventory. Again, as you think about goods, we start with raw materials. Then we take our raw materials and we move it to work in process. And once the work in process is done, we move to transfer it to finished goods. Once the item is sold, we move, or we take it and move it to cost of goods sold. And that's just the flow of how those costs go. And this is again from the manufacturer's perspective. So let's look at the inventory, the financial statements and all of that. But the most important thing when you're thinking about a service organization versus a merchandising versus a manufacturer, there are some differences in different layers. Again, a merchandising firm does not have raw materials. A merchandising firm is going to have their inventory that they purchased. A manufacturing firm will not have merchandising costs. They're going to have raw materials. They're going to have finished goods in their raw materials. They're going to have those kind of costs. So understanding those differences are going to be very, very important as you're looking at the two, because when you're going through these chapters, you're going to see that depending on what perspective this particular problem is coming from, you're going to be gleaning from a manufacturer's perspective or from a merchandiser. So knowing what relevant costs and irrelevant costs are important. Irrelevant costs are going to be some costs, those costs you've already incurred and they can't be changed. Relevant costs are going to be costs that are giving you options on differential costs. What's going to be the difference between two alternatives? I have this alternative versus this alternative, and what's the difference between this is our status quo, this is what we think we want to do, and what's that difference? So costs that are fixed and variable. Costs are going to stay exactly the same regardless of the activity. In the case of a manufacturer, regardless of how much you produce in a period or in a particular manufacturing process, the costs are going to be exactly the same. No change whatsoever. However, variable costs are a little different. They're going to vary. The more you work, the more volume that you produce, the costs are going to go up. And they may not necessarily go up in the same proportion, but the bottom line is it's going to go up as your production changes. And then we have our variable costs, direct materials, direct labor, manufacturing overhead. And again, direct materials are going to be variable costs. Direct labor generally is going to be variable because in some cases you're dealing with hourly people, you're dealing with overhead costs. So in general, your labor costs may very well be considered a variable cost. Manufacturing is going to be a mixture of the two. Again, we're allocating costs, indirect costs, to the various products that we're trying to produce. So, for example, total cost is going to be the total cost plus the variable cost per unit times the number of units that you have produced. Very important calculation. This is a calculation. This is one spread that I think you should print out and just use it as your source of calculations, because you're going to be calculating many different types of formulas. And it's important to note that TC, or total cost, is going to be extremely important, and you're going to see this often. So it might be one of those types of calculations that you want to put on a cheat sheet or on a card so that you can remember, how do I calculate my total cost? Average cost is another calculation. Again, you're going to take your total cost and divide by a number of units. But your TC, again, is another cost that you have to remember. This is going to be following you quite a bit. So knowing how to calculate, or knowing what the constituents of a total cost calculation is going to be critical for any other calculations, for many of the other calculations that you'll be working on. So marginal cost is going to be taking the cost of making one more unit. And again, we're talking about different types of costs and what they mean. For you as a student, I would say the most important terms that you'll need to remember is, how do we calculate total costs? What are period costs? What are sunk costs? How are they? What costs are relevant and what costs are not relevant? What makes up direct labor costs? And how is that classified, fixed or variable? Again, those are the different types of costs and the different types of concepts that you'll really need to understand in this chapter, because we're going to be using all of these concepts and they're going to be used interchangeably throughout the remaining of the book. So knowing them and getting an understanding of what they are, how they're applied, and the calculations is going to be quite important. Thank you very much for your time, and I look forward to talking to you in the next chapter.